Hey everyone, good afternoon and welcome to Finding Solid Footing, a 2021 market recap and 2022 outlook. Thank you so much for taking the time to attend our webinar this afternoon. My name is Susie Entrata Abrera. I will be your host and moderator. To formally open our webinar, let's welcome on screen Maricar Lopez, Trust and Asset Management Trust Officer and Group Head.
Thank you, Susie, for that introduction and welcome. Good afternoon, everyone. So, first of all, I would like to take this opportunity to thank everyone for continuing to choose and trust Security Bank for your banking needs. We could not have done this without your support during these unprecedented times. Again, welcome to the first webinar hosted by my team, Trust and Asset Management Group, for this year 2022. As you have seen in our invite, our webinar has for its title, Finding Solid Footing. So this theme could not be more apt. While the last 2 years were all about surviving and resilience against headwinds, I am certain that all of us here today are now hoping that 2022 will be about finding solid footing, whether in our personal day-to-day lives, in terms of running our livelihoods and businesses, and in our investment choices and decisions. Our speakers for this afternoon's webinar, that would be Dan, Dino, Basil, and Noel, each one a subject matter expert in their fields, i.e., reading and analyzing macroeconomic data and trading and analyzing the fixed income and equity markets. We'll share with you where we are now, how our country is crawling its way back to find solid footing from 2 years ago, and if this will be sustainable in 2022. I hope you will gain insights from this webinar and help you navigate your way towards choosing the right investment products and asset class, i.e. bonds and or equities, or perhaps help you in rebalancing your investment portfolios. So without further ado, I will pass on the platform back to our wonderful host, Susie. Thank you again and good afternoon.
All right. Thank you so much, Maricar, for that warm welcome for all of us. And of course, very hopeful welcome also. And looking forward to the rest of our program this afternoon. Now, I'm honored to introduce the first speaker for this afternoon who will talk about the Philippine economic outlook. He is Security Bank's chief economist. Ladies and gentlemen, let's welcome Dan Rosses.
Thank you. Good afternoon. Thank you, Susie, for that warm intro. Um, okay, so my task today is to present to you first, no, the macroeconomic update. No, that's something that we've been seeing in the markets lately. One that has been or news that has been moving the markets lately. No, and the second part is very quickly a run through of our 2022 economic outlook to help you with your investment decisions. Okay. So let's begin. Um, okay, so two major things now happening in the US. Now, one is that employment cost is going up. The second is that CPI is running hot as well. So with Omicron beginning to pass, we're expecting that employment cost index could actually be higher. No? And what that means is a wage-induced inflation on top of the inflationary pressure that the U.S. has been experiencing. No? So that 7.5 print, actually 7.5 no, as of January, no, the main cause of that is energy prices going up. No? There's enough pressure uh, towards the Fed, no, the U.S. central bank, to raise rates, no, to arrest inflation. So us, we're thinking that they could likely begin with a 25 bips rate hike this coming March. That's going to take around possibly 5 to 6 hikes this year in order to slowly normalize policy and also help arrest inflationary pressures. No? So in the meantime, between that and uh, the rate hikes, no, we should expect um, some volatility. No? Well, not some. No? We should expect volatility, and that's going to affect the local GS market and the FX markets as well. Next slide. And then we have several risk factors in 2022, but the two main uh, uh, risk factors that we are tracking is China's slowdown and also oil prices. Now China's growth slowdown is attributed to that property slump that we saw in 2021. That led to a contagion, no, that affected industrial production, also retail sales. So what that means to us is with trade with China, no, China being our largest trading partner, could be affected up until the medium term. Why until the medium term only? The PBOC, or China Central Bank, already did some preemptive growth support, and we're expecting some fiscal support also. But that takes time. No? So in the medium term, trade with China would likely get affected. That's going to affect our exports more than imports, no? And that should lead to a wider trade gap, which almost always leads to a depreciation of the peso. Second is oil futures because of uh, demand going back and also geopolitical risk. No? That Russia-Ukraine thing is also adding on to the pressure or the bullish outlook towards oil prices. So we're expecting oil prices to remain elevated this year. No? The question really now is, what's the trajectory? No? There are two possible scenarios. One is that if that conflict in Russia between Russia and Ukraine gets drawn out or extended, it could hasten the trajectory of oil prices faster. So it could likely end up at around $100 per barrel, probably by the end of the second quarter, no, or much earlier, no, depending on the situation. The second is the de-escalation and also Iran uh, uh, getting allowed again to produce enough oil. No? So that's going to level or stabilize oil prices. No? So what that means is oil prices could likely remain steady at the 90s level. No? So it's going to remain elevated either way. Um, what that means is global inflation could likely remain sticky. And in fact, that reinforces our view for um, flatter curves in the USTs and also higher rates. No? Uh, in the meantime, we have transportation, manufacturing taking the brunt of higher oil prices. No? So that's adding on to the inflationary pressures globally. Next slide. And then locally, we have you have oil, no? Still a headwind towards price pressures as well. Um, but inflation, no, mathematically could remain within target in 2022. What that means is that inflation could likely lie between the 2 to 4% in the months ahead. No, so that actually gives some room for the BSP to remain accommodative in the medium term. No? Why the medium term? Because that we're also already seeing some demand side pressures emanating from inflation. No? The main cause of inflation lately has been cost push. So you have oil. On top of oil, we have food prices as well, which was the main inflationary cost last year. It's still elevated. No? So what that means is that it remains susceptible to possible supply snags. No? So that's an upside risk as well. Um, it's cost push. But the economy is slowly recovering. No? So we're beginning to see demand pull, also the other kind of inflation, beginning to emanate itself. Um, the main indicator to that is price inflation in the restaurants and services side. No? Demand is going back. No? If you pile that onto the cost push side, what that means is it could lead to some secondary effect towards inflation. So likely the BSP will remain accommodative for the first half, but they'll likely be reviewing policy by the second half, no? Or probably, well, after that review, no? They'll likely do the start of policy rate hikes by around 25 bips by the second half. No? 225 bips is what we are penciling in. In the meantime, it's important to watch out for the month-on-month because the headline could be a bit deceptive given we have a new base year and we have favorable base effects. So the month-on-month will be very informative moving forward. No? So right now, the December to January month-on-month inflation is quite high. No? Despite the fact that the headline inflation went down, the month-on-month was high at 1%. No? Right now, we are attributing that to Typhoon Odette. No? It could likely be transitory still. But if that becomes persistent in the months ahead, meaning 1%, 2%, no, that's going to cause the BSP to panic. And they'll likely be trying to normalize policy earlier than expected. Next slide. So we're also expecting growth for the first quarter to get hit because of Omicron. Now, mobility, which is a very good leading indicator of household consumption, it did regress back in January to pre-November levels. No? However, it did not go to as low as what we saw during Delta. No? And we think that the government will try to keep the economy as open as possible as long as the hospital situation allows. So what's the hospital situation? It's vastly improving from January. As of early February, it's just averaging around a little around 37% in terms of utility. Contrast that to what we saw during Delta. We were pushing 90 to 95%. No? So the health situation isn't as dire as what it was during Delta. That's also the reason why some other indicators did not go down as expected. So what we are seeing is a very fast recovery after Omicron passes. No? So you have the usual suspects recovering first. You have manufacturing, you have retail, you have wholesale, you have transportation storage, and tourism and accommodation. No? Tourism and accommodation could likely benefit from revenge travel spending. It's something that we saw in the fourth quarter already, no, but unfortunately Omicron happened, so it got pulled back a bit. No? So that could likely return once Omicron passes. Next slide. Okay, so official 2021 data showing growth already improving. No? Seasonally adjusted numbers point towards recovery after that cratering in the second quarter of 2020. So its growth is returning. No? But we have to watch out for unemployment levels, which remain elevated. It's getting very hard for the labor market side to get absorbed because of the effects of the scarring, because of the scarring effects of the lockdowns that we saw in 2021. So that's why in 2021 it ended at 6.6%. We are expecting that with improving or a sustained momentum of recovery this year, we could likely hit that natural rate of unemployment of 5%. That's the pre-pandemic average for 2022. Manufacturing is also proving to be quite resilient. It was in expansion for most of 2021. No? Yung 50 level ng PMI being the neutral rate. No? So it was in expansion for most of 2021. In January 2022, at the peak of Omicron, it only regressed back to 50. So it was at neutral, meaning it neither contracted nor expanded. And that's encouraging because that shows that manufacturing is resilient and responding to the demand given by a rebound in possible rebound in consumption. No? So it did not go back to, it did not go down to as low as 46.4, no? Something that we saw last August during Delta. No? So it's remaining to be quite resilient. Consumer confidence also turning less negative as of the third quarter last year, but we think it has already turned positive no, as of the first quarter. Business sentiment will always follow where consumer confidence is, so we're thinking that consumer confidence will also be turning around no, in response to where consumer sentiment is. Next slide. So that's the backdrop. No? Our baseline view for 2022 is a recovery of up to 6.5% growth year on year on the back of normalizing activities. Next slide. So economic indicators that we modeled showed encouraging prospects towards economic recovery. So that's 6.5% year on year. The nominal value is 19.6 trillion versus 2021's 18.5 trillion. No? So all the components of growth is expected to grow by this year, but the main lever, if you will, is actually household consumption. Next slide. So that rebound in consumption will be the key driver. No? It might grow by 8% this year, but that's still equivalent to 75% of the GDP. So the main factors for that will be herd immunity getting attained in the first half of this year. So likely we will get 66 million fully vaccinated adults by March. And then if you add on the kids, no, 110 million by May. So that's our base case. No? So that's herd immunity in the first half. That's going to improve sentiment tremendously. No? And of course, with improved sentiment, the government uh, will see that looser curbs is working. No? So we should expect less stricter curbs, probably localized lockdowns only. No, if there are flare-ups in certain areas. So um, the bottom line is that it's going to improve mobility. So mobility, especially the retail side, is a good indicator, a leading indicator of growth. So that's also going to mean that consumption is coming back. No? And remittances will also remain a key component. No? Remittances is uh, correlated to GDP growth by around 56%. No? And in this pandemic, it's estimated that around 10 to 15% of remittances go towards household consumption. No? And then last year, it grew by 5.1%. That's already pre-pandemic levels and all-time high. So it's remaining resilient. No? In fact, in 2020, it only contracted by around 0.8%. So remittances are expected to grow further this year. That's going to contribute towards household consumption for 2022. Next slide. And then we have investments rebound on the back of that view of rebound in domestic consumption. So investments could likely grow by 12% this year. We are still seeing some spare capacity in manufacturing in terms of capacity utilization. It's still 17% below pre-pandemic levels. So what that means is, a rebound in consumption will mean more supply that has to get produced. No? So manufacturing slack will likely narrow, and that narrowing will lead to an uptake in employment, no, towards manufacturing. What that means also is that PMI will also report expansion. And PMI is closely correlated to GDP by 90%. No? So directionally, if PMI is in expansion, that means GDP will also be in expansion. Um, Also, 2022 is an elections year. So we could investments could likely benefit from an election spending offshoot. For context, during election year, growth average is 6.2% versus 5.1% in a non-election year, no? Excluding 2020, of course. No? And drilling down into the data, we saw that investments, specifically infra, were contributing towards new investments. No? Despite the fact that there's going to be a spending ban in March to May, um, um, there are a lot of infrastructure projects that remain unfunded. So it always leads up to extra funding for that after the elections exercise. No? So that's going to contribute as well, and also generates jobs, um, as well as promotes consumption. No? So investments could likely grow this year by 12%. Next slide. And then we have government consumption. With looser curbs, revenue collections will, of course, go up because more businesses are open. So what that means is there's less pressure to collect revenue. So the shift or the focus will be on the expenditure side. No, sorry. Um, Expenditures can then shift towards a targeted spending plan. So that also helps narrow the budget deficit. It's going to go towards all those stalled investments I mentioned earlier. And we're also expecting that pandemic spending will be lesser because one, it's already programmed into the 2022 budget, which is 11.5% higher than 2021. Second is that the health situation is getting better, though. So likely um, uh, we should expect less of, for example, Bayanihan 1, Bayanihan 2 reallocation of funds. No? So um, uh, expenditures will become more targeted. No? So that's also good for long-term growth. Government consumption expected to go up by 4.5% this year. Next slide. And then we have net trade. No? Net trade could be the drag in the overall GDP equation. But a wider trade deficit is expected nonetheless. Exports, or rather exports growth potential, could be suppressed by that slowdown in China. It's going to affect agricultural exports primarily. Um, that's on top of the elevated shipping costs and supply chain constraints that we are already experiencing. So exports could only grow by around 8%, no, on estimate. Imports, on the other hand, will benefit from that rebound in domestic demand. So that means there's going to be increased appetite for imports. Importers will want to supply that demand, no, despite higher commodity prices. And what that means is that they will also demand US dollars. They will demand more local. They will demand more US dollars locally. No? So that means the peso could likely weaken. Next slide. So inflation moderation is our view for 2022, but the risks are tilted on the upside nonetheless. No? So demand pull, like I mentioned earlier, could likely become more pronounced because of that consumption rebound. No? So BSP still has some room to remain accommodative given that the average inflation could likely be 3.5% this year. I think the BSP in the earlier monetary board meeting, no, they're expecting already 3.7. No? So there's significant upside risk to that. No? So they'll likely remain accommodative, but the second half we are expecting a policy rate hike to 25 bips in terms of policy rate. Next slide. And then in terms of government financing, we are seeing more of the same. We have 77% domestic borrowing, 23% foreign borrowing. No? So BSP could likely remain supportive of the national government's financing needs, especially with around 1.225 trillion maturities in GS bonds. No? So they'll likely be offering the facility this year, no, until such time that recovery is more stable. But inflation, nonetheless, is expected to remain within target for this year. So that eases the pressure a bit. No? But if growth is stable in the second half, we should expect likely that there's going to be a move towards the longer end, no, of the curve. Next slide. And then we have FX, no, expecting a lot of volatility in this space, a lot of pain points to contend with. No, you have local elections, you have that Fed rate hike, you have wider trade gap, you have global commodity prices. And then relative to the central banks that affect our FX levels, you have a hawkish Fed plus a dovish BSP, which almost always leads to a depreciation of the peso. So we are expecting, for now, that by the end of the year, we'll be at 52 pesos to the dollar, no, in terms of FX. So hedging is recommended, no, given that there's a lot of volatility coming our way. Next slide. This is a summary of our forecast for 2021 and 2022. For 2022, 2021, we had a very nice hit rate. So we're trying to replicate that this year. A lot of the numbers in the 2022 column were discussed in the presentation, but let me talk a bit about GAR, gross international reserves. That's expected to be lower this year compared to the 108.9 billion finish that we had in 2021. The reason for that is that part of the GAR might be used by the authorities to control the volatility in FX. No, so they'll likely be using it specifically for that. No? So that's why we think FX could likely be at 52 pesos. No, because of that support that could come from the reserves. No? And then we have debt and fiscal deficit. Both could likely remain elevated this year with all the borrowing and spending that the government will be doing. Um, but we do expect those two indicators to begin normalizing by next year, meaning it's going to go down primarily because there's a new administration in town. No? So with the advent of the new administration, whoever wins, no, it always leads to a fiscal consolidation. So that fiscal consolidation could likely temper the debt and fiscal deficit levels. That's it for my part. Thank you very much, and thank you again for your time.
Thank you so much, Dan, for such a comprehensive presentation. It is comforting to know that we are seeing a light at the end of the tunnel. And as you discussed, economic indicators point to encouraging prospects of economic recovery in 2022, of course, despite some headwinds. All right, thank you for that. Our next speaker is Dino Aquino, Vice President and Head of Fixed Income of the Trust and Asset Management Group, to share the fixed income outlook for 2022. Let's give a virtual round of applause for Dino.
Thank you, Susie. Good afternoon, everyone. First and foremost, I would like to thank everyone here in attendance for the opportunity to present our outlook for 2022. Today, I will be providing a market outlook for your fixed income investments. Okay, next slide. Before we proceed with the outlook, I would like to provide a recap of last year, 2021. So it's in order for us to have a better picture of what to expect this year. 2021 was indeed a challenging year for fixed income investments as several market disruptions were seen last year. We can summarize 2021 into four parts. Okay, first is the reflation story. Reflation story was the reflation in 2021 we were introduced to the reflation trade. The reflation trade was focused on a reopening play on a classic risk-on scenario with rotation from bond investments to equity investments. After 2 years of generous returns for investors in the fixed income market, they shifted to equity investments as the reopening of the economy takes center stage. So number two, of course, it's the Fed's transitory story. In the second and third quarters of 2021, rates consolidated mainly due to a dovish Fed stance, with their view that inflation at that time is temporary and can be attributed to the opening of the economy. As a result, global bond rates steepened as liquidity kept short-dated tenors very low. Number three, we were introduced to two new COVID variants, of course, Delta and most recently Omicron. During the second and third quarter, rates consolidated at that time, given there were several lockdowns in the US, Asia, and even Europe. So growth prospects took a back step as COVID fears were once again back in the picture. The 10-year notes at that time was trading at a range of 1.10% to 1.3%, which was very stable during the period of second and third quarters of 2021. Lastly, which is the most important that sets the stage for this year, 2022, is the Fed's 180-degree turn from their dovish stance in the second quarter. So after staying dovish for the most part of 2021, during the Fed's September meeting, Fed Chair Powell recognized that inflation is indeed a real threat. As a result, analysts revised their rate hike forecast in 2022 from one hike to at least two hikes. Rates resumed their rise globally, with the US 10-year notes once again breaching 1.5%, which was last seen in the first quarter of 2021. Next slide, please. So again, these events in 2021 sets the stage for what to expect in 2022. Unfortunately, barely 2 months into 2022, we were once again facing a number of headwinds. Of course, these include Omicron, which inflation, again, the hawkish Fed, and most recently, the Ukraine crisis. So for Omicron, though we are at the tail end of the latest COVID variant, certain ports remain congested, like Hong Kong, which saw a spike in cases recently. Port congestions, unfortunately, may lead to higher importation costs and hence higher inflation. Meantime, as mentioned by Dan prior, the US hit 7% on their year-on-year inflation on back-to-back months, which is the highest in 40 years. To put things into perspective for everyone, the last time the US inflation was at 7% their US 10-year note was at 15%. It's currently just at 2% now. So it's indeed a negative carry for holding US debt at this point. When it comes to the Fed's March liftoff, it's already a foregone conclusion with market pricing in 25 basis points rate hike. Room for a half point hike remains in the picture, but the said move could probably spook the markets, which are already very sensitive at this point. Hence, the Fed might go to a more conservative route at first, by raising just 25 basis points. As mentioned by Dan earlier, the market is pricing in around 4 to 6 hikes, which is in line with current interest rate levels. Do take note, however, pricing in risk events such as Fed hikes is very tricky, and it won't be a surprise if rates further accelerate after the first hike in March. When it comes to the Ukraine-Russia feud, it's quite in its early stages. They have been relatively in conflict for a long time already. Um, there were reports of an earlier bomb explosion, but of course, it's not official. The last official news is that Russia pulled back some of its troops, which provided some relief to risk markets lately. This, though, is an event that has to be monitored because it has a potential to be a black swan event and also a potential to be a non-event. So this is something that we should consider moving forward. Next slide. So, okay, Dan presented this earlier, but I would just like to highlight the US inflation for the past 5 years. So if you notice, since 2020, it's been a steady rise, but the trajectory accelerated in the first 2 months of 2022. Of course, the 7% inflation, if it's sustained for more than 3 months, this could pressure the Fed to ramp up their tightening pace. Next slide. Okay, so this is a 5-year chart of similarly of our local inflation forecast. Local inflation situation. As Dan mentioned, it's on a downtrend. This is basically due to the rebasing from 2012 to 2018. The latter, of course, is a high inflation year. So the headline could be a little bit tricky. So it's really important to look at the month-on-month increase. The month-on-month in January, as Dan mentioned, was at 1%, which is very high, especially from a month-on-month standpoint. So it's really important that we should monitor this moving forward, especially if it's attributed to a debt, so it was likely move lower in the next few months. But of course, this remains a concern. Next slide. Okay, last chart that I'm gonna show, it's a comparison of the US 10-year note and the local 10-year note. The blue line, the one on top, represents the Philippine 10-year note, while the white line is the US 10-year note. As you can see, the spread between our bonds and the US 10-year bonds have widened since 2021, as an abundance of supply brought about by higher local borrowings has been the main driver. I would just like to highlight two important dates on the left of your screen, October 2018 and currently February 2022. Last October 2018, that was the height of the inflation scare in the Philippines. The local 10-year note climbed as high as 8% versus the US note of around 3% to 3.2. So that's around 4.8% spread between our 10-year note and the US 10-year note. This proved to be a good buying opportunity, though, at that time as yields dropped the following year by an average of 200 to 300 basis points, highlighting a banner year for fixed income and where most fixed income funds generated double-digit returns in 2019. Currently, the spread between our 10-year note and the US 10-year note is at around 3.3%. That's our local 10 years around 5.4% versus the US 10-year around 2%. So definitely, with the trajectory in US rates and the rates on the rise, we might see the trend to continue and likely the widening to also continue given the headwinds we mentioned prior. Okay, next slide, please. So what are our key takeaways given what transpired in 2021 and the headwinds we faced in 2022? So rates have seen their lows as yields have been trading at an artificially low level in 2020, brought about by a pandemic-induced economy. So in 2019, we saw global interest rates drop because of lower inflation. In 2020, central banks lowered their interest rates due to the fact that the market needs some stimulant to normalize their activities. So the tightening cycle is upon us as yields globally trend higher in the next 1 to 2 years as economies normalize. So coming from a pandemic, it's really important for economies to normalize their interest rate scenario. If just to give you an idea, German interest rates are actually back to positive after trading at a negative territory in 2019 and 2021. Generally, rates move in a cycle. After two banner years in 2019 and 2020, we saw a reversal in 2021. Most likely in the next 1 to 2 years, we expect the similar scenario that happened in 2021 before a consolidation and another downtrend move, which was last seen in 2018 when rates peaked as illustrated in the chart prior. When it comes to inflation, though, this again, we keep reiterating, Dan reiterated it, I am reiterating again, it's really an issue that we need to look into closely. It's being, the market, I think, is looking at it quite conservatively. There are already parts in the US, I think Atlanta and Florida have seen an inflation of 10%. So that's something that we should consider moving forward. Local inflation is expected to remain contained, but if oil prices continue to surge, it's the BSP governor indicated that as long as the oil prices stay below 95 per barrel, then inflation can be contained. So it's something that we should consider moving forward, and it's something of a concern for us. Next slide. So this just summarizes our outlook for 2022 and balance it with our risks. Volatility in the market is expected to continue, and an upward trend in interest rates are intact. Dan mentioned volatility over and over again, and I'm going to mention it as we expect volatility to actually to increase in the next 3 to 4 months, given that there are a lot of risk events and a lot of headwinds. The only question now is how high can rates go up? To manage our fixed income portfolios, it's ideal to keep duration short and maximize our accrual income over capital gains given the move in interest rates. With inflation being the biggest risk we face in 2022, it's prudent to minimize volatility of the securities we hold in order to find solid footing amidst what looks to be an even more challenging 2022. So, yeah, that ends my part on the fixed income markets. Thank you so much once again for the opportunity to present to all our valued clients. Stay safe and hoping for a much better year ahead for all of us. Thank you.
Thank you so much, Dino. Maraming salamat for your in-depth insight and outlook on the fixed income market. Indeed, there exist some challenges as you discussed, but the overall climate seems more hopeful in 2022. Now, before we move on to our final speaker, I would like to invite our audience again to please take part in our real-time interactive poll. You can either scan the QR code or click the link set in the chat box. Again, the full questions are, number one, what will you do once COVID-19 cases continuously decline and restrictions ease? And second question is, what do you think will be the next major positive trend in the Philippines in the next 5 to 10 years? We are really hoping for your participation, and of course, thank you in advance. Now, ladies and gentlemen, our final speaker for today is here to share his equities outlook for 2022. Please welcome Basil Go, Senior Assistant Vice President and Head of Equities of the Trust and Asset Management Group. The floor is yours, Basil.
Thank you for giving us the opportunity to present today. Hope you guys are doing well. Let's start the first person slide. So in this slide here, it's just a look back in 2021. The Philippines was one of the worst performing markets globally. We were basically flat on a peso terms, no. But if you translate into US dollars, given the weak currency against the dollar, we had the 6% depreciation. The market was down 6.2% in dollar terms. So you'd see in 2021, the markets that did well were generally economies that were able to contain the pandemic. No, the Philippines is definitely a laggard. So hopefully, looking at 2022, next slide, please. So as of Feb 4, ASEAN, if you look at the markets that are in the left hand, in the top performing markets, you have Singapore, Hong Kong, Philippines. Actually, if you update this, even Malaysia is already up year to date. So Philippines, Indonesia, Thailand, Malaysia, the ASEAN countries, Singapore, are the best performing markets year to date. And if you look at globally, US is down 6%, the S&P 500. If you look at the European markets, the stocks 500, it's down 4%. So there's generally a rotation from growth to value stocks. As mentioned by Dan and Dino earlier, rates are going up, and definitely higher interest rates are generally bad for tech stocks. So if you look at the Nasdaq, it's it was down as much as 16% in January. Um, and we think that this shift from growth to value will benefit ASEAN markets, especially the Philippines, given a big part of the market is mainly in value stocks like banks and property. Now we don't have a lot of tech stocks in the Philippines, so that is good for our market and for ASEAN. Next slide, please. So this is a history of what happened in 2021 and year to date. So generally, in summary, if you look at what transpired now, we had multiple lockdowns, and every time we had lockdowns, whether you had ITF changing their jargon from MECQ, ECQ, then we're now they changed it to alert levels now from 4, 3, 2, and 1. So if you look at, just want to highlight several things in the third quarter. We were placed in alert level 4 because of the Delta variant. And when we had the Delta variant, the market really went on a risk off mode. But once we shifted back to alert level 3 and 2, the market rallied in the third to the fourth quarter. But once in the fourth quarter, December, January, we reverted back to alert level 3 because of the Omicron surge. No? But even if you look at what transpired from March 2022 until now, we're basically back at the index of where we are now above 7,400. We're basically back where we were near the pre-pandemic levels. No, so hopefully we break that 7,500 resistance that's been really hampering our market, and hopefully reach our year-end target of 8,000. Next slide, please. So this is a summary of what the best performing index stocks in 2021. So in summary, the best performing stocks in 2021 were mainly defensive stocks like the telcos, Globe, PLDT, Converge. A lot of people spending time from working from home, so that is definitely good for broadband, and of course the e-wallets like Gcash and Paymaya. And I guess a common theme as well is the banks have done well. But BDO, Metrobank, BPI, one of the better performing stocks in 2021. And and given that we have the outlook that is mentioned by Dino and Dan, that we continue to believe that the Fed will hike rates this year, that should be positive for NIM, net interest margins for banks, which will hopefully trickle down to their bottom lines. And if we look at the trends in the industry, loans have been registering growth for the past couple of past and fourth quarter, and non-performing loans trends have been improving now. So as the economy reopens, mobility will improve. That should benefit banks and hopefully property names as well. Mobility improves, mall foot traffic should also improve. Those stocks already comprise a big chunk of the index. Next slide, please. Just here's just a snapshot of what transpired in the third quarter now. So, although admittedly some companies have already reported fourth quarter earnings, just in summary, if you look at the 3Q numbers, as mentioned earlier, despite the Delta wave, no, and the country shifting back to rigid lockdowns and alert level 4, no, the corporates have been able to adjust to the new normal, given mobility restrictions now. So we believe that starting this year now, probably 3Q to 4Q, we think that earnings could potentially be back to pre-pandemic levels, meaning 2019 levels, by the second half of this year, which should be beneficial for the market. Next slide, please. So this is a chart on the foreign flows. No, the Philippines is such a small market that we are highly dependent on foreign flows. If we look at the past 4 years now, from 2018 to 2021, we registered over $3.6 billion of outflows. But that 2021 figure is a bit deceptive. No, if you strip out the Aboitiz, the Jera acquisition of the Aboitiz stake, and the increase in stake of ARAN of AC Energy, outflows in 2021 would have been $1.8 billion now. So without those blocks, outflows in 2021 would have been 1.8 billion. So cumulatively for the past 4 years, outflows for the market is around $5.6 billion. So given this backdrop, the foreign ownership of the market, if you look at the right table there, it's already at 21.7%. It's at multi-year lows, no. All we need is the foreign funds to stop selling for the market to move up. We don't need a lot of them to be buying. The reason being, next slide, please. If you look at the foreign participation in the domestic stock market, there's been a shift, no, from highly dependent foreign inflows for the market to be higher. If you look at the trend for the past 3 years, foreign participation has been dwindling, and domestic participation has been increasing now. So from 45% in 2019, we're now at 64% in 2021. And what's also encouraging is that also retail participation, meaning the regular Joes have been also increasing from 2019 to 2021. No? So from 2019, it was just at 18.2% and now at 31.1%. So if this trend continues, no, this should help propel the market higher. If you look at other markets in the region like India or China, those markets are really domestic or retail driven, which really helps like India last year, no, despite their COVID, despite the country being unable to contain the COVID pandemic, the domestic market was quite strong because of domestic flows, no. So I think the same, given that hopefully the same trend can happen here, the domestic market could be propped up by domestic funds and retail investors. Next slide, please. So this is just a comparative table of the Philippines relative to the region. No? If we look at the valuation, no, we're at 17 times. This is based on Bloomberg consensus. So you could say, if you compare us against our peers, you could say we're quite expensive. But I would argue that not really. Firstly, if you look at the EPS growth, we're at 43%. So compared to the region, we're quite attractive at over 43%. Admittedly, we're coming from a low base, but that is in fact, like, if your foreign investors in fact attracted to that, because we're quite behind the curve now relative to developed markets. So the fact that we're quite late in terms of coming out of this pandemic is in fact making us look more attractive relative to our peers. And if you look at our average relative to the 10-year PE, no, we're trading at 1.1 standard deviation below the 10-year average, which means that we're quite cheap, no, relative to historical standpoint. Next slide, please. So what I showed you a slide earlier that the PE may not be attractive, no, compared to our peers. But if we look at under the hood, no, the 30 index names, a big chunk of that PE, high PE, is driven by a few stocks, now the big cap names like SM Prime, JGS, Ali, SM. But if you look at the other stocks in the index, they're in fact trading at significantly below price to book or earnings ratio, price earnings ratios, no, 1 to 2 standard deviations below the historical average. So if you strip out those stocks in the index that are skewing the PE at the higher, at the 17 times, we're in fact quite cheap, no. So I think this is bodes well for a stock pickers market. We think those big cap names won't move as much, but the cheap banks and some property names could really propel the market higher. Next slide, please. So what has the performance of the stock market been for the previous 5 elections now? So we did our study now for the past 5 elections: 1992, 1998, 2004, 2010, and 2016. So if you invested your money on the election date and 12 months after, you'd made on average 24%, no. So if it's, for instance, if today is already May, no, the election date, you invested all your money, on average you'd return 24%. And based on the previous 5 elections, your returns are all positive, no, with the lowest being in the last election, in 2016 at 13%. The question is why does this happen? No? Usually, when there's a new administration in place, there's generally a positive sentiment, the honeymoon period. People are optimistic, no, and usually there's a PE re-rating, no, a 10% PE re-rating, which signifies that there's new confidence in the government, and hopefully things will change, no, for the better. That's the reason why historically markets do well. I mean, 12 months post elections. Next slide, please. And what makes us attractive relative to, I would always present this to our clients. No, the Philippines is attractive relative to other developed markets like US, Europe. You know, we have aging economies like Japan. They have aging population. What makes the Philippines attractive is we have a young and dynamic workforce. The median age in the Philippines is just 25.3 years old now as of 2019. And we're one of the biggest exporters of labor now. We have a lot of OFWs, which and we have a young workforce now, which makes us a very attractive market for BPOs as well. We have a lot of young English-speaking Filipinos, which leads a lot of BPOs to open shop here. So given that, no, if you look at the old age dependency ratio, we're quite low, below 10%, because the old age dependency ratio is basically the people in the workforce that are able to work divided by the old age population. No? So we're really young, and the population won't peak until 2050. So that gives us a lot of runway because we're a consumption-driven economy. 60 to 70% of our GDP is consumption-driven. So that should really propel growth for decades to come for the Philippines. Next slide, please. So what are the risks now? So I presented quite a bullish outlook, but I think this will also be elaborated later by Noel. As mentioned, interest rates, the higher interest rates go, definitely that should, if the Fed is more hawkish than usual, then that should be bad for the markets, meaning that they'd hike more than what the market is expecting. Higher inflation, commodity prices. The Philippines is dependent on imports of commodities like oil, so that should be bad for the currency. No, currency, a weaker currency would be bad for the market, and the elections definitely is a risk. No, and of course, a variant that is transmissible or more lethal, that is also a risk. Next slide, please. So I would end with this slide here. So key takeaways. No, I guess I would like to highlight that the corporate listed corporates have already adapted to the new normal. They've been able to adapt their business model, e-commerce and all that. They're very lean at that like right now. They've been able to cut costs, so that's why earnings have been quite resilient despite the lockdowns. And as I mentioned, despite the foreign outflows, no, foreign domestic participation has been increasing, whether retail and domestic institutional investors. No, that's been propping up the market. And of course, the region right now, if you look at uh, the previous elections, markets have historically done well 12 months post elections. The Philippines is in a demographic sweet spot. And of course, the last slide I mentioned that the risk are elections, the variant, the inflation risk, and a more hawkish Fed. So, in a nutshell, our year-end targets 8,000. Hopefully, this will be a better year than last year. Thank you.
Thank you so much, Basil, for sharing your views on the equity market, highlighting that while there are setbacks along the way, the country's economy is still poised to grow in the coming years. Now, I'd like to invite Noel Reyes, Chief Investment Officer of the Trust and Asset Management Group, to give a wrap up of the speakers' presentations. Noel, take it away, please.
Thank you, Susie. Good afternoon, ladies and gentlemen. You have heard from Dan on our current more positive economic forecast, from Dino on our cautious fixed income expectations, and from Basil on our optimistic outlook for equities after 2 years of hard and volatile markets. Let me summarize their key points and put them together. But before that, allow me to take you a trip back from 2 years to recall our prior themes during our previous webinar. At the beginning of 2020, our theme was swimming the trench as the pandemic just broke Nearly all countries are being affected, and there was no precedence to guide us, as the last known experience was over 100 years ago during the Spanish flu, and no living person could provide on a clear direction. We were faced with a deep ravine and a future that we could not imagine. Panic and fear were high, and so we said this is a trench that we needed to swim to survive. Then at the start of 2021, some good developments began to sprout. The discovery of vaccines in late 2020 had started production at the onset of 2021 for global distribution. Some countries and companies also have learned to adapt better ahead of others. New ways of adjusting are paying off economically and spreading to other countries quickly. Mobility has improved with shorter periods of lockdowns and more lenient restrictions. Panic has eased significantly, but fear still remained on catching the virus. Nevertheless, then we can already imagine and finally see that there is an end to this. However, we still needed to keep our guard and sustain all our early gains further in order to reach that end. Hence, we needed to keep swimming. At the start of this year, 2022, we begin a more positive pace. Last year saw significant confidence to return and growth came back on economy, corporate earnings, and jobs to the point that the aftermath now is the concern on inflation and ending stimulus by governments and central banks worldwide. At least we can now touch the ground and we just need to navigate and find solid patches to firmly anchor our game. Hence, we are finding our solid footing. Next slide, please. Again, let me present the key facts in 2020 just for a good comparison. Back then, we did not know what to do as nobody had experience or expertise. Some countries were fumbling in the dark. Some were frozen by strict lockdowns like us, having the longest lockdown of all. And we learned the hard way trying to adjust, trying to survive, and it was a period of trial and error. New attitudes and culture needed to develop. And fear was prevalent, even with vaccines starting to be developed late in the year. Vaccines encountered resistance and still were limited in access then. Overall mobility was low, hence the massive slowdown in the economy and in business. All these long periods of closures and time of high unemployment, the end result was negative growth all year round for a lot of sectors. While in 2021, confidence was improving as vaccines got deployed. Low at first, but sped up later, and we saw the distant light. That was an end to all this. Government, business, and people pursued adjustments, developing short, medium, and long-term solutions. Experience yielded better models and levels of mobility during spreads as vaccine confidence grew and allowed better planning. We developed new alert levels that allowed for higher movement despite COVID breakouts. The expansion of digital commerce got fast-tracked and evolved from better efficiencies, while increased mobility renewed physical consumption, and both complemented each other. Hence, as business reopened more, we finally achieved positive growth and negative GDP growth was now behind us. Truth be told, improved mobility, improved economy, reopened businesses, reduced unemployment, and all countries did had that did had the same experience. Next slide, please. Now, finally, summarizing our points for this year. The economic reopening, more with a wide vaccination levels, with Omicron variant helping out, proved the pro-vaxxers right. Recent surge affected like a normal flu to the vaccinated, low mortality, and we had a shorter period impact. Hence, we believe we are migrating already from pandemic to endemic. Vaccine openness and acceptance have become wider now. To cite, NCR has reached 80% vaccination rate for people complete with 2 doses. Calabarzon with 60%, and remember both regions, NCR and Calabarzon, comprise about 50 to 60% of GDP. While if you look at the entire Philippines, we have reached about 55% inoculation rate. A greater majority of business and people have largely adapted, achieved, undertaken major changes. We reformulated, banks have reformulated their operations. Retail pursued cost rationalization. efficiency improvement, and adjusted products. Digital commerce evolved as a new sector, increasingly accepted and will remain and will become part of the new normal because it still has room to grow. As an example, the experience of GCash alone, not to plug the app itself, no, they experienced gross transaction value of about 3.8 trillion. No? That's in fiscal year 2021. That was a growth of about 3 times over fiscal year 2020. So imagine the amount of transactions and volume that could be generated, and even revenues, no, that could be sustained and derived from by the government. There were a total of 55 billion registered users, which is roughly about 50% of our population, and with daily logins of about 26 million. So this means renewed physical activity has reformulated also during the fourth quarter because of the adjustments in operations, and this also boosts consumption and property. And we are now looking at the new normal, which is the complementing digital and physical consumption space. Remember, consumption comprises about 70% of our GDP. Hence, GDP growth forecasts by analysts have been varied. We ourselves are at 6.5%, but the range is from about 5.5 to a high of 7.5%. This kinds of projections indicate a sign of high confidence, and the real GDP will actually reach pre-pandemic levels, no, by the latter part of this year. Most analysts are seeing by the third quarter because we're just a short number away, no, from breaking the 2019 levels. Increased domestic production is good for business, increases confidence in new investments and expansion, which will translate to better numbers for corporate earnings, and therefore better employment and higher consumption. We actually had a taste of this complementing experience in fourth quarter 2021 when both digital space, no, and physical activity were more pronounced. This year, we can add tourism to the equation because the government has now reopened tourism nationwide, and this will bring foreigners back to the Philippines and add on to the consumption spending. It is worth noting to cite the strength we have, why we're able to overcome the pandemic. Our BSP has been ahead of the curve and managed the policy and our gross international reserves very well. And hence, they received accolade as the best central banker for 2021. Our heroes from abroad who remained steadfast in repatriating their earnings to their families here boosted staple consumption and supported residential property sales from sinking. BPOs gave the extra hand to developers on keeping revenue growth on office leasing. And to emphasize the fact that despite the lockdowns, we had a well-capitalized banking sector, which is the backbone of any economy. The banking sector was able to weather past dues and defaults, and we had because it also gave evidence to the fact that we had strong listed companies that adapted quickly to the changing environment. We avoided catastrophic effects as a result. You can gather that from our position, we are positive for 2022, especially in the economy and the stock market, but these are not without risks. As emphasized by all of us, all the stimulation has led to inflation, and now the biggest risk is higher interest rates as countries try to contain an overheating of their economies as demand surges as more restrictions are removed. The Philippines, though, may be in a better situation as the consumer price index or inflation was rebased to 2018, where we saw higher price levels, and this tempers the growth this year, though mathematically. Case in point, January inflation was just at 3% year on year. Black swans remain and will be, as experienced, continue to disrupt markets. A new deadly variant may have a result in a need to impose stricter lockdowns, which can again choke the economic reopening. Elections this year in May is another black swan event. If unruly or if the winner disrupts the programs already in place, that will keep foreign investors out. And finally, geopolitical risk from the nearly 8 years of conflict between Russia and Ukraine that have escalated significantly in recent weeks, and these have not yet been priced in our markets. Overall, the renewed growth in the economy and widened mobility will only be good for the stock market, but the fixed income market will remain challenged but presents good opportunities later. For equity markets, we have a chance to see double-digit returns. If invested at the end of 2021 and with 8,000 as our year-end target, that's about a 12% return. Do note that we are still on the conservative end in terms of projections, as other forecasts are in the area of 8,200 to 8,700 even. So why buy? As explained by Basil, I emphasize two main key points. No? We have a relatively cheap valuation from historically from being ignored over the last number of years. And we were ignored by foreign investors. And once they return, we can only imagine how much of an impact it will create in terms of upmove. The second one, of course, is the local bid coming from both institutions and retail have stood up and grown stronger. They picked up the inventory sold off by foreign flow during the past 2 years. That's why we've seen a regain of markets at the end of 2020 and 2021. Given that we're nearly at the middle of our 8,000 target from last year with 7,500 nearly today, any sell-offs would be welcome. So sell-offs will be shallow. So I suggest to always keep buying the sell-off or invest during the sell-off. It was proven to be a good strategy over the past 2 years, and even before that, buying the dips have always been a very good strategy. On the other hand, the fixed income market will see a higher trend in rates, and we'll see volatility in the next few months as the central bankers address inflation and policy rates. Patience is needed. While the trend will be higher for rates, this also means that at a certain point later, it will be good for the buy and hold investors eventually, as well as for bond funds. Invest short duration for now, then shift to longer maturities later. This ends my summary, and thank you, and have a good and safe year ahead. Back to you, Susie.
Thank you. Thank you so much, Noel, for summarizing and bringing in your own expertise and knowledge into this webinar. Now, before we move on to the Q&A and poll results, let's hear from Carmi Lim, Head of Sales and Client Acquisition. She'll talk about the different options to help maximize your investments. Carmi?
Thank you, Susie. So good afternoon, everyone. Thank you for giving us this opportunity to present how Security Bank Trust and Asset Management Group can help you reach your financial goals, and to also present to you our different trust products and services. So just a brief update on where we are right now. So as of June 2022, our AUM stands at 86.1 billion. We primarily manage the funds of our clients, and our investment philosophy is to deliver consistent above benchmark investment returns through active fund management. We follow a disciplined investment process. There's teamwork, and we focus on risk. On the next slide, we present here our different investment and trust products. So first and foremost, we have our Security Bank Unit Investment Trust Funds, which I will discuss more in the next slide. For wealth planning, we have our Personal Management Trust. We manage customized discretionary funds through an investment management account, or you may also opt to set up a directed email with us where you get to choose and approve each investment. We manage the retirement funds of companies for the benefit of their employees, as well as pre-need corporate trusts. And we also offer escrow and facility agency services. Now, on the next slide, let me discuss briefly our 7 funds. So we have 7 Security Bank unit investment trust funds to cater to every type of investor. So in addition, we also have 3 feeder funds giving our investors access to offshore investments. So to date, we have our SB Asia Pacific ex Japan feeder fund, our US Equity Index feeder fund, and our Global Equity Index feeder fund. And we are looking to offer more options soon. So hopefully when we launch our new funds, we could have another webinar and you could be present as well, so you could hear the opportunities that these funds will present. Next slide, please. So through the years, Security Bank Trust and Asset Management Group has won multiple awards for fund management. And most recently, we won an award from the CFA Society of the Philippines. So our SB Peso Bond Fund won as Best Managed Fund for the long-term peso bond fund category. And in 2020, we also won three awards from the Asset Hong Kong. So that would be Top Investment House and Most Astute Investor for the SB Dollar Bond Fund and the SB Peso Bond Fund. Next slide, please. So just allow me to sell Security Back Trust and Asset Management Group for a bit. We really strive to go above and beyond for our clients. And this is what I think differentiates us from other institutions. So just an example, we enumerated some of the extra services that we give to our clients. So we offer online investing in our SB funds through Security Bank Online, as well as promote regular savings and cost averaging through our regular subscription plan for UITFs. We regularly conduct client webinars, such as this one, to give our view of the market on our different trust products. And we also give financial wellness or financial literacy webinars for retail clients. And we can also do an exclusive financial literacy webinar for our corporate clients. We also send regular and timely market updates through EDMs, Facebook Live, and other social media posts. And we also offer competitive fees versus industry. So again, as Susie said, we would love to help you reach your investment goals, maximize your returns, and service your other trust needs. So if you're interested, you can reach us through your RM, wealth manager, branch manager, and we will also flash our contact details at the end of the presentation. Thank you.
All right. Thank you so much, Carmi, for sharing information on these value increasing products available. Now, before our webinar, we received questions from you for our different speakers. We'll prioritize asking those questions. And for those who have other questions, please type them in the chat and we will do our best to get to them if we have time. Otherwise, we'll make sure to respond to them after the webinar. But before we begin with the Q&A, let's see the poll results. And thank you so much also to everybody who participated in the poll. Let's see. What will you do once COVID-19 cases continuously decline and restrictions ease? Okay, let me just make that bigger on my screen so that I can see your responses. All right, it says here 37% travel abroad, Europe, Japan, USA, 26% visit family and loved ones, 21% travel locally, that's Boracay, Palawan, et cetera, invest in UITF stocks, bonds, and states, et cetera, et cetera. Okay, we'd like to call back some of our speakers, actually, what they think of the results. Okay, we'll check with Noel and Basil. What do you think of the results of the first poll question? Hi,
Oh,
Noel.
hi, Susie. Thank you. Well, I think this is pent up demand that's working out. You notice it's really more in the area of travel. So it's
Yes.
either traveling globally or traveling domestically or visiting
Mm-hmm.
loved ones you've not seen in a long time because of the
Mm-hmm.
lockdown. So I guess that's really more the thing that's going to happen. In fact, I think in my own experience, we did that also in the short periods that we were allowed to move out of the house.
Yes. Mm-hmm.
With family, we tried to take advantage because
Mm-hmm.
we realized so also that we've seen so much people that have passed away over the
Mm-hmm.
past 2 years that
Mm-hmm.
trying to maximize time with family is now very essential. No? And I think that's the one thing that came out good out of this pandemic that people
Right.
families are closer to each other.
Yes. Valuing our relationships, our close relationships that maybe not the men have taken for granted, but because we always knew we could visit them and our friends are always just there for us, and then suddenly we couldn't see them often, and that's what we want to do. Of
Right.
course, Basil, what do you think? Pero third lang yun kasi nauna pa rin yung traveling abroad to Europe, Japan. What do you think, Basil?
Yeah, I mean, it's not surprising. I mean, if you just look at other markets that have come out of this pandemic much earlier than us, travel has been back. I mean, domestic travel no, has been back to near even higher than pre-pandemic levels. If you look
Mhm.
at the markets like the United States, in fact, recently, if you look at news reports, Cebu Pacific already operating at 48% capacity, and they plan to ramp it up eventually to full capacity by the summer, potentially by the second quarter now. So that speaks confidence that that they think that domestic I'm travel could really be propelling the market. International travel could take some time, no?
Yes.
Yeah, so
Mm-mm.
I agree.
Nice. So they're calling it the revenge travel, right? I mean, we haven't spent any money in terms of travel when maybe in a year people would travel maybe once or twice a year, etc. And we haven't been doing that. So that's what they call revenge travel. So next time, revenge investment naman, try din natin. Okay, we have got our full question number two, and let's check out the results of that one. All right. So I thank you all so much, everybody who participated in our poll today. And of course, later on after the program, we're going to ask you guys to, give us a bit of feedback, and that also has some nice results. You know, gifts for you guys. The first five who will respond to our poll after will appreciate that, of course. Okay, you know what? While we're waiting for that to load, maybe I can ask a few questions for our speakers for this afternoon. And the first question would be, okay, let's load that up. What is your view on the USD or Philippine peso for the coming months and at the year end? How does a COVID surge affect USD, PHP, and other markets? And that question is for Dan Rosses.
Hi, thank you for
Hi,
that
Dan.
question. It's a difficult question nonetheless, no? But primarily because this year is a very difficult forecasting environment. So, but based on what we have been seeing lately, no, the USD, USD PHP for that matter is experiencing a very strong resistance at the 51 and a half level.
Mhm.
So um, the general view is for a depreciation. So that's likely going to be pointing towards that. That's primarily because of, well, we have, like I mentioned earlier, we have Fed rate hikes. We have that uh, oil prices
Mhm.
surging. And then you have volatility as well, and then you have local elections. So all those point towards a weakening of the peso. No? Um, uh, Primarily because, for one, the USD will be stronger, and there's always a negative relationship between the two. So the USD will be stronger because of some sentiment-driven movement. No? But that's the initial view. No? Likely, um, um, it could change tack now, for all we know, given that it's such a very volatile environment.
Mhm.
And then we also have that view towards less stability this year, leading to a hawkish Fed. And then we have our local BSP now uh, getting dovish a bit. No? But I think based on the rhetoric this afternoon, they're turning towards, well, they're pivoting towards a bit of a hawkish tilt. No? So that
Mhm.
means that the peso would likely be strengthening a bit. No? So a lot of factors happening this year in terms of where the USD PHB will be in the coming months.
Mhm.
Um, um, but if there is a solid parameter, if you will, as regards to where that will be, uh, we can follow the guidance of the BSP. No? And they
Mhm.
said that they are comfortable with the level of 48 up to 53 pesos to the dollar. So that means those are the levels that are expected that could end up no, towards the FX markets in the months ahead. Um, but with the view that that the peso is going to weaken, no, so that means it's pointed towards the 52 level. We could actually reach the 53 level sometime within the year, no, if conditions are right for it.
Mhm.
But like I said, no, there's a lot of resistance at certain levels, so the peso will have to hurdle that before we could see a move towards the 53 level. I mean, it's
Mhm.
still early to tell, but with all the indicators pointing towards weakening, that's also the view that we are sharing.
Mhm.
So that also goes hand in hand with a COVID surge. Um,
Mhm.
the surge actually, uh, well, the main indicator to that is, if we have a COVID surge, hot money flows out. Now we can see that when the PSEI goes down. Now what that means also is that the peso is weakening. And after a COVID surge, the economy is said to be going back on track. So what that means is actually um, that there's more investor positive investor sentiment towards the Philippines. So hot money comes in, that points to an appreciation of the peso. So that's the volatility that we are facing this year.
Right. Well, thank you so much for that. Now we have a follow-up question for you. What can we expect in the latter part of 2022 in terms of inflation, consumer behavior, and retail sector developments?
Okay, the retail sector is a very good indicator, of where household consumption will be. And like what Noel mentioned earlier, that's around 70 to 75% of the GDP. So that's a very good indicator of growth. So what we are expecting the latter part of 2022 is that inflation could likely uh, be still remain within the target of 2 to 4%, no, likely in the high threes. But um, consumer behavior, if momentum is solid up until the end of this first half, no, we can expect that to become quite stronger towards the latter half. No? So consumer revenge spending will come back. Hopefully, international travel is open once again. No? So that's going to lead to more revenge travel spending. And then the retail sector will always benefit from that, no? Because retail spending always goes to the retail side. And also, um, if, barring some very bad surges of new variants, we could expect that, we are a consumption economy. So that means people will be back with the vengeance, no? Doing the shopping and all.
Yeah.
So hopefully that's what transpires in the latter part of 2022.
Sounds very hopeful, Dan. I think we can see
Thanks.
that there's a bit of movement going towards that direction already, towards retail, no? And a lot of them have been very hard hit also because of the pandemic. So we're slowly moving forward to, some sense of normalcy in terms of spending.
That's right.
Eh, yes, my credit card can attest to that. Okay, our next question is for Dino Aquino. What is your view on interest rates this year for the Philippines and the US?
Good afternoon. Thank you for the question again. Well, our view, as mentioned earlier in my presentation, is definitely rates will rise in the next few months or even for the next year. As we're currently at a low interest rate scenario, given the fact that we came from a pandemic. So government, central banks, the U.S. Fed, the BSP had to support the economy in order for us to stay afloat during that time, that hard times in the pandemic. So by supporting us, they cut their interest rates by 200 basis points to 2% locally right now. But of course, as we go back to normal, revenge shopping and all, we have to go back also to normal interest rate scenario. So as we proceed over the next few, as we look ahead in the next few months, as Dan mentioned, we will expect the BSP to raise interest rates in the second quarter and likely another one next year or in third quarter of this year. So with that, again, Noel mentioned the risks involved when it comes to fixed income markets and the volatility that we've seen in the markets. But again, this also presents as an opportunity for us to have higher yielding investments, especially those to the more moderate type of investors. Some investors actually are looking at fixed income investments more than equities because they want a steady stream of coupon payments. Let's
Mm,
say currently we have an RTB issuance of 4.875 coupon. If you actually hold that to maturity, it's actually not bad if our inflation is contained, as Dan mentioned. But of course,
mm,
we have to be mindful of the risks. So
mm.
our view is interest rates will move higher and move back to normal in the next 1 to 2 years. But of course, this also presents as a buying opportunity and a chance to invest in higher yielding investments. Thank you.
So now is the buying opportunity, is that right?
Not yet.
Not yet.
Down the line.
Sabihan
Down the
mo ako,
line.
Dino.
Yeah, because we might see some ano pa eh, there's still the Fed and the BSP hasn't really moved yet. So we have to wait for them to move and before that we have to wait for them to move and how the market reacts. Of course, there's a lot of risks pa as in the peso, the elections.
Yes,
But then
yes.
again, it could be a good investment down the line
Mm-hmm.
if you're looking at more moderate investments. Thank
Okay.
you, Susie.
Thanks, Dina. Okay, we've got another question for you. Now, according to the BSP, for as long as crude oil prices do not go above $95 per barrel and settle there, then we should meet the inflation forecast of 2 to 4% target. That said, what is your inflation play for this year, and what fixed income investments can you recommend to beat possible rising inflation?
As Noel mentioned this, the 95 per barrel currently is due to the tensions in Ukraine and Russia. At this point, it's highly likely that the intention that it will escalate. So the 95 per barrel may not last long in the next few months. So it would be temporary at this point. So with that,
Mm-hmm.
we expect inflation to be intact at 2 to 4%.
Mm-hmm.
When it comes to fixed income investment, this is quite tough. As mentioned, diba, the U.S. markets, the U.S. inflation is at 7%, and their 10-year yields is just at 2%. So that's negative 5% in terms of carry into holding fixed income securities. But locally, if we do keep our inflation within the target of 2 to 4%,
Mm-hmm.
as of recently, there are a lot of issuances when it comes to corporates that provide decent spread. This could be a good play when it comes to inflation, especially in the short term. 2-year bond, corporate bond issuances of around 2.7% to 3% would be ideal to hold if inflation remains in target at 2 to 4%. And then
Mm-hmm.
down the line, we can also invest in longer dated corporate security or fixed income securities if inflation stabilizes and then yields remain at current levels, and it's going to be very attractive then.
Oh,
Thank you.
nice. Oh, thanks for that, Dino. All right, our next question is for Basil. What is your outlook for the PSEI and S&P 500 in 2022 among the SB feeder funds, Asia excluding Japan, US, and Global Equity Index feeder funds? Which among the three should best perform in 2022?
Yeah, that's a handful of questions. So I guess first thing I would ask the person is to ask them what their current asset allocation is. No, so
Mm.
without knowing the current asset allocation, it's kind of hard to answer that question. But definitely, it's not prudent to put everything. I mean, don't there's a saying, don't put all your eggs in one basket. No, so because even if we're bullish, as I mentioned earlier, we're bullish domestic equities. Our target is at 8,000. I would, as an investor, uh, it's also good to diversify your exposure in other countries, like the US, definitely some Asian exposure. Because at the end of the day, diversification is only the free lunch we have now. That is the only way you can mitigate risk and improve your overall returns. But as if you're a trader, uh, like us, we can do tactical trading. Definitely with the higher interest rates, I mentioned earlier that it's definitely not good for growth stocks now. If you look at the tech stocks in the US, NASDAQ, I mentioned earlier, down as much as 16% in January. It's down 10% year to date. S&P 500 down 6%. If you look at Europe, stocks 500 down 4%. The only markets that are doing well are, in fact, countries that export commodities given the rising prices now. So if you look at the Middle Eastern countries, Saudi Arabia, those markets are doing well. You got some Latin American countries, Chile, doing well because they're good. They're exporters of goods like copper and all that. So if I would recommend short term that Asia will do well. I mentioned there was a slide I showed earlier that if you look at ASEAN, if you look at Malaysia, Thailand, Philippines, Indonesia, Singapore, those markets are up, up year to date now, despite global markets down. So short term, given that these markets are concentrated in value stocks and banks, we believe that these markets will do well. So Asia exposure, especially how China has done poorly in 2021, we think that the worst is over for China,
Mhm.
and the valuations are quite attractive. So we think that Asia could outperform in the short term. But if you're from a long term perspective, no, I wouldn't discount the U.S. market.
Mhm.
U.S. market, if you look at the big cap names in the U.S., uh, these companies are the cream of the crop now. These tech companies like the big tech names like Apple, Google, Amazon, they've consistently delivered earnings growth. So if you look at just the last 10 years, the compounded annual returns of these companies, the S&P 500 is 15% for the compounded annual for the past 10 years now. There's no country that's done better than that. So I would recommend no for short term definitely Asia is good, but for long term you can diversify US, some Asia. If you don't want to think about it, just buy the global index. No, just that's 50% US and spread across other markets. So just do a, as mentioned by Carmi, do a peso or dollar cost average your salary every month, then invest for the long term. That should reap you the best reward.
Right. Wow. Thank you. Such great advice. Thank you, Basil. Our next question is for Noel. 2022 is the election year, and at the same time, the supposed recovery year from the pandemic. How will the national elections impact markets?
Well, Basil has mentioned that our stock markets normally yields positively up to 12 months after, no, during the past historical election experiences that we've had. I think he emphasized it's because the markets, in short, the markets gives the winners or winner, a grace period, no, to allow for them to present their program of government and economic agenda. This year should not be any different unless it, as I mentioned earlier, no, that the black swan risk that it becomes unruly. Um, and if there's no continuation of the economic program that's already been laid down by the past three presidents in effect, no? That's something that kasi that has to be continued for us to sustain our growth. So and our markets, no, to finally reach back the high of 9,000 that we've had, no, historically. We're still below that high, all-time high. So I think that's one. Meanwhile, on the bond markets, even if it's an election year, no, I don't think policy rates will be affected by the election results. The focus of the BSP is on, or any central bank for that matter, is on managing inflation and economic performance. No, so I don't think they will change their focus, and they will actually be I mean, hovering like an eagle, no, over inflation and economic regeneration for the Philippines, given that this is something that will help the general population. And the governors even also again emphasized that fact that they will not act until really solid real GDP growth is achieved. So I guess for the bond market, the effect will be less muted.
Mhm. I see, I see. Thank you, Noel. Our last question is also for you. Is it advisable to switch from aggressive funds to moderate funds during this pandemic? Where can we invest for the short term and long term, considering the current economic situation?
Well, the experience we had in during this pandemic, not since
Mhm.
2020, that held true. No, the volatility on the equity markets was so huge. In the swing of the Philippine Stock Exchange Index, no, came from 7,800 at the end of 2019 to 4,600 at the start, no, of the pandemic in March 2020, and then it ended 7,150, no, for that year or at the beginning of 2021. Then the surge and the surges of the COVID uh, led the index to fall again to 6,200 in May and again in August. No, before ending the year nearly about 7,128 2021 now last year. That the kind of volatility, if you from being in an aggressive fund, is there. That's why it's advisable to switch. So the short answer is correct. No,
Mhm.
because during that time the bond funds outperformed. No, 2020 they earned double digit yield. No? Because that time the government has to stimulate the economy because of the lockdowns and closures. So and the only reason why 2021 became difficult for less aggressive funds because inflation scenario picked up, and that's a different factor already. That's no longer the pandemic, and we are entering the endemic phase now. So it's again we're entering a different phase. So that's why the best investment, if we go back to my last slide earlier, would still be again, given that regrowth no, of all economies and companies rebuilding will translate to higher economic activity, higher economic consumption, higher investments and expansion. So that's going to be good for stock market. So it should be better to remain no, aggressive at this point. If you are, and again, let me just add something. No? It also depends on your risk appetite and purpose.
Mhm.
No? You cannot sleep with the volatility of the valuation movement on equities and long-term bond funds. And the safe bet is to just go stay on the short term or bonds. No, you can actually, we also have a DEMA product that you can look at, no, which can provide you with returns of both on GS on corporate, but you have to buy to hold. You cannot sell it. No? So that means if you buy something longer no, than now because rates anyway are higher, so you can at least lock in a yield of let's say 4.5 to 5.5% gross on a corporate issuer. No? So that's still decent in a way, especially so that this next 2 years that we're going to experience is the period of high interest rates. And again, as mentioned by Dino, it's a cycle. So high interest rates then coming in the next 2 years, which is basically if you look at last year, that's the first year. This can be the second year. No? So 2023 can be a period of lower rate. So let's see, right? So it depends. So if you are somebody comfortable with those kinds of fields, and you don't
Mhm.
like the volatility, then you can just invest in that and in our DEMA product, and we can lay down that hold to maturity kind of investment.
Mhm. Mhm. All
Mhm.
right. Thank you so much for that, Noel. Thank you to all of our speakers, Noel, Basil, Dino, and of course, Dan, for answering our questions. Now, before we end our program, we'd like to show you guys again the results of poll question number two. I think we weren't able to show it to you earlier. Okay. So here, the question was, what do you think will be the next major positive trend in the Philippines in the next 5 to 10 years? Now, 43% of you answered tech and digital consumption boom. 12% said demand for property in the suburbs. 18% of you said emergence of environmental, social, and corporate governance focused companies. 27% of you said hybrid work situation across various industries. And there are no major positive. Nobody answered that. So I guess number one is 43% tech and digital consumption. I'd like to ask Dan and Dino for their comments on this. Let's start with you, Dan.
Yeah. Actually, I agree with this finding. No?
Mm-hmm.
Um, there's a looming tech and digital consumption boom that's closely correlated, I think, with that hybrid work situation.
Mm-hmm. Mm-hmm.
No, so those two go hand in hand. So it's no surprise that this will be the top two. I think uh, what has to be considered at the moment now is if um, there are plans for expanding that reach. No, so I guess what the survey findings show is that we are just bound to consume what's available to us. No, so maybe something that we have to look forward to will be an expansion of the industry as well, no, in
Mm-hmm.
order to service the higher demand for it. No, but
Mhm.
yeah, I generally agree with the findings.
Nice. Well said. Thanks, Dan. What about you, Dino?
Yeah, I agree with Dan as well. Actually, when it comes to digital and tech, actually, in the Philippines is in its infancy stage. If you had to
Mm-hmm.
put it correctly, because if you look at offshore markets, like for example, in Hong Kong, you can actually buy products online. That's not really just stock market. You can buy paper, liquid gold. You can buy derivatives. You can buy different products that's being offered online. In
Mm-hmm.
our case, I think Basil has the numbers. Only a limited number are invested in equities, and of course, given the situation now where everything is digital, even my son knows how to use MS Teams. Actually, he's just
Mm-hmm.
5 years old. So
Mm-hmm.
it's really the direction we're heading into.
Mm-hmm.
I personally, I don't like. technology, to be honest. I prefer, for
I
example,
agree with you.
yeah, I prefer meeting in person, having a meeting in person and seeing
Mm-hmm.
the person than virtually.
Mm-hmm.
Well, but it's a trend that we really have to accept. And of
Yes.
course,
Yes.
the developed nations have already moved into that. And I think eventually, the Philippines will follow, given the direction of that. Basil mentioned also, we're also a very young, but very young generation coming into to about 25 years old. So these guys are actually looking into more advanced technology than the older generations.
Yeah.
Thank you.
Thank you. So resistant to technology also, but it has is its advantages, I must say. I mean, meeting all of you here and learning from everybody here this afternoon is definitely one of them. So thank you so much to all of our speakers. Guys, for those of you who sent questions that we were not able to cover, we will make sure to get in touch with you after. And thank you so much for sending in your questions. Again, thank you so much to all of our speakers for the insightful presentations and for addressing the questions from our audience. Thank you as well to our clients who joined us today. If you still have any more questions, please feel free to share them with us through your relationship manager or via email at trustmarketing@securitybank.com.ph. Now, after 2 years, the COVID-19 pandemic has profoundly changed the way we live, including the ways we invest. We hope that today's webinar has given you significant insight in the face of today's evolving investment climate. Now, before we officially end today's webinar, we'd like to get your feedback. So please scan the QR code flashed on your screen or click the link sent in the chat. Now, we encourage you to answer it now because the first 5 clients to complete the form will be given a special gift from Security Bank. Now, I'd also like to congratulate the first 5 clients who submitted their questions in advance. Now, the team will also reach out to you after the event. Once again, ladies and gentlemen, thank you so much for joining us this afternoon. My name is Susie Antrata Abrera. Stay safe, everyone.